In this video, I still want to emphasize the fact that the key ingredient of success in stock market investing is nothing but knowledge. The more knowledgeable you are, the higher your chances and probability of making money in the market. And the least knowledgeable you are, then of course, the greater your chances of sustaining losses in the market. And so I want to emphasize 10 critical rules of knowledge in stock market returns. The rule of knowledge in stock market returns. And so knowledge plays a crucial role in stock investment returns. And so here are 10 key rules that knowledge plays in investment outcome. Number one is informed decision making. Informed decision making. And so knowledge allows investors to make informed decisions about which stocks to buy, which stocks to hold, or which stocks to sell based on an understanding of company fundamentals, market dynamics, and the economic condition, the prevailing economic condition, as at the time of the time you are holding that particular investment. Number two is risk management. Risk management. So understanding different types of risk. You have a market risk, you have sector risk, and you have company-related risk. So you need to be conversant with all these different kind of risk. Market risk has to do with the entire market, the entire stock market. Sector risk is related to the sector or the industry, in which you've bought the stock from. And the company-specific risk is a kind of risk that is inherent to the company itself. So this helps investors manage their portfolios better, reducing potential losses and enhancing returns, in the process. Number three, valuation analysis. Valuation analysis. So knowledge of valuation techniques such as price-earning ratios enables investors to assess whether a stock is overvalued, whether the stock is undervalued, or whether the stock is fairly or rightly priced, fairly valued, which can guide investors' choices, in this regard. So you need to have a knowledge of what price earning ratio is all about. Price earning ratio simply means the current price of the stocks, divides by the earnings. So that will give you the price earning ratio. The lower the number, the better. Number four, market timing. Market timing. So while timing the market perfectly is challenging, knowledge of market trends and cycle can help investors make better entry and exit decisions, potentially enhancing or improving our returns. Although we don't really advocate, timing the market, but we encourage time in the market. These are two different terminologies altogether. And so you buy the stock at the right time and you sell at the right time will go a long way in enhancing the level of returns you are going to accumulate in the market. So market timing is very, very important. Number five is diversification. So understanding the benefits of diversification help investors spread risk across various assets or various sectors or industries or even regions, as the case may be, reducing the impact of poor performance in any single stock. For the fact that your stocks, your holdings are widely and evenly diversified across different sectors, across different industries, and sometimes even across different geographical kind of entities, that particular process on its own will help you to avoid risk that may occur or arise in a given sector that will have a negative impact on your stock. By so doing, you end up having what? A better result, a better return than accumulating your holding in a single sector or in a few sectors that could be affected negatively by market conditions. Number 6 is behavioral insight. Behavioral insight. And so, knowledge of behavioral finance help investors recognize and avoid common psychological traps such as hard behavior or overconfidence, which can lead to poor investment decisions. It is very good that we have an in-depth understanding of behavioral finance, because sometimes, if not most of the times, investor behavior, behaviors are kind of, influenced by emotions like fear, emotions like greed, instead of logic or reason or company fundamentals. And so, by the time you understand by the time you understand how investors behave under certain conditions, that will help you to know precisely whether to be in the market or to be outside the market, whether to buy or whether to sell. And by the time you take these particular decisions accurately and appropriately, that will end up, enhancing the level of returns will eventually obtain in the market at the end of the day. Number 7 is economic indicators. Economic indicators. A strong grasp or understanding of economic indicators, example, interest rates, inflation, GDP growth, and even unemployment levels. All these indicators, are factors you need to consider even as investors. So it helps investors anticipate market movements and adjust their portfolios accordingly. I think you have in-depth knowledge of how the economy operates. What do you do when there's a hike in interest rate? How do we invest? How do we invest when there's high inflation? What should be your strategy of investing when there is an enormous growth in GDP? So these indicators actually will influence your investment strategies on how you go about buying and selling stocks. And this in-depth knowledge will eventually, help you to buy at the right time, the right stock, and to equally dispose at the right time the stocks that need to be disposed. So you need to have an in-depth knowledge of economic indicator. You should be an economist, even as an investor. Number 8, long-term perspective. Long-term perspective. Knowledge encourages a long-term perspective, helping investors to stay focused on their goals and avoid reacting impulsively to short-term market fluctuation. The markets will inherently fluctuate. All right, just like babies cry, old men are full of wisdom, young men are full of energy. So the market actually is known to fluctuate. All right, somebody asked JP Morgan how the market will behave. He simply said it will fluctuate. And so when the market fluctuates, because the fact that he's so knowledgeable about the fact that yes, markets sometimes, market movements sometimes are governed by trends and sentiments, you should be able to hold to your investment without selling, believing that yes, your investment will eventually recuperate and do very well. And so this knowledge, will help you to have a long-term perspective, a long-term horizon when it comes to your stock holdings. It's simply a matter of how knowledgeable you are, that market sentiments do not persist and will not persist forever. And eventually, reason will prevail and the market will end up correcting itself, in a positive manner. Please subscribe to this channel and like this video. Number 9 is tax efficiency. Tax efficiency. Understanding tax implication of investment decisions. Example, whenever there's what is called capital gain tax and even dividend tax. You see, when you hold an investment for a long time and eventually sell it, you will incur a lesser level of capital gain tax. But when you sell an investment, within a short period of time, you will incur a high level of capital gain tax. And so this knowledge should be incorporated into a decision to sell your investments at any given point in time. So it allows investors to maximize tax returns. After tax returns, through strategic planning, you plan on when to sell, particularly. And not only that, you also take into consideration when it comes to dividend investing, and you consider the level of tax your dividend is going to attract, and that will help you to determine precisely what to invest and what not to invest in, what to expect and what not to expect at the end of the day. Number 10 is continuous learning. Continuous learning. The stock market is dynamic. All right, and ongoing knowledge acquisition ensures investors stay updated on new trends, regulations and tools, allowing them to adopt and optimize their investment strategies continually. And so we can't afford to just invest and go to sleep. You have to be updated, you have to be current, you have to be, aligned with current trends in the market so as not to be left behind. All right. And so keep yourself, in tune with market activity and market condition. That level of knowledge will help you to be able to perform very well at the end of the day. And so leveraging knowledge across these areas can significantly enhance stock market returns over time. Once again, the more you learn, the more you earn.